Hello, friends. So today Oracle earnings came out and we loved it. Everything looks handy dandy. Seems like they have a lot of growth years ahead. They're investing for that future revenue. And so far, seems like market is buying the story. Stock is up almost 10%. That's a great news. And a few weeks ago, we had another bad news related to BlackRock, one of the largest asset manager in the country, who one day just woke up and say, hey, I'm not going to let my investors take their money out. They froze the fund and market panic when that happened. And we saw the sell-off. Then we ran into this Iran-United States conflict and people got distracted with that. And now we're all worried about the situation with oil, because when oil prices go up, they affect everything in the economy, especially our gas prices. So everybody's starting to pay attention to that. And now we are also worried about the inflation that will come along with those gas prices. So I thought, when we have so many news going on at the same time, it's very easy for us to lose focus on something that is happening underneath. So I want to talk a little bit about that, and I want to show you guys how that situation with BlackRock actually impacts all of us, not just investors in BlackRock. So those of you guys who don't know me, my name is Deepak. I run a tax firm called Tax Code Advisors. You can go to taxcodeadvisors.com. You can reach out to me from there. I also run a coaching program where I teach people about finance. And when BlackRock comes out and say, hey, investor cannot get their money out, what does that really mean? It means all of a sudden that fund has become illiquid. So we need to understand what liquidity means. In simple terms, liquidity means that how quickly can you turn your asset into cash? Like, for example, if you have a stock, you can sell it right away, turn into cash. But if you are invested into real estate, your house or an investment property, you cannot do that. You cannot press a button and sell it. Although, with blockchain and all that, that might be coming in near future. So we might see that soon. But anyhow, as of today, you can't do that. So in the grand scheme of things, liquidity is the flow of money through the entire economic system. It's how money moves from bank to businesses, to workers, to consumers, and then back again. Think of it like water in a pipeline. When water flows freely, every tap in the house works, or in your community. When the pressure drops, some taps slow to trickle. When it stops completely, the whole system breaks down. Right now, BlackRock's situation is telling us that pressure is dropping. So here's a framework I want you to keep in mind going forward. You need to look at liquidity at different stages. For example, cash, money in your wallet or checking account, immediately available. Zero friction. That is the gold standard of liquidity. When people sell assets, whether their home or their stocks, it's usually for one and one reason only. They need money. If they didn't need money, they can ride the volatility and don't have to lose that asset. The stage 2 of liquidity is operational cash. Money your work or business generates. Rental income, business revenue. If you're a W-2 employee, your salary, maybe you have a side hustle. So this depends on things working. And here's the problem right now. With interest rates, 6%, many real estate investors who were generating cash flow in 2020 or earlier are barely breaking even today. So they are hurting with cash flow. In matter of fact, even in our WhatsApp group, you probably have seen how the rent in Austin market has dropped and many people are really having a hard time renting their property. So they're running into cash flow problems. As you guys know, I file a lot of tax returns, and many times when I talk to people who own a lot of rental properties, they are running into cash flow issues. They bought it because they thought the market is going to appreciate or continue to appreciate, or they thought maybe the interest rate will come down or rent will go up, but none of that happened. So they're stuck with this cash flow problem. Then there is this whole AI fear. People are worried that they might lose job. So again, operational cash. Then let's talk about savings. Smart people keep 5 to 20% of their wealth in liquid reserves, ready for emergencies or opportunities. This is your buffer. This is what separates people who survive a downturn from people who get wiped out. So if you're a good investor, I want you to think about that for a second. What kind of assets you have that are liquid? Number two, what confidence you have in operational cash flow going forward. And number three, what do you have as a dry powder? Now, I'm not talking, when I say dry powder, I'm not talking about you invested into stock market or into real estate, stuff like that. Dry powder means dry powder. That means you can go to bank and get that money, and then you can do whatever it is that you want to do. Okay, so far, so good. However, there's another way to generate liquidity in your life as well. And that is extremely important, especially if you have a side hustle, you're a business owner. We call it credit access or line of credits, home equity loans, bank lending, line of credit for your business. This is borrowed liquidity, and it only exists when banks are willing to lend. When banks tighten their standards, and they are tightening them right now, this liquidity can completely disappear from the system. And this is one of the main reasons why people who invest on margin gets completely wiped out, because at any moment, your brokerage firm can decide to take that liquidity away. They don't care whether your portfolio is up or down. They can just say, no, we want to get paid, and you got to pay back to them. And then lastly, you have an option to sell your long-term assets. For example, maybe you will hold on to gold, which you don't want to sell and you want to pass it on to your kids, or you own a real estate property. If bad time come, those assets still have some value, so you might think about selling them. Or even worse, sometimes I see people taking money out of their retirement account. And that solves one problem, that they have an immediate liquidity, but then they run into tax consequences, and oftentimes they're selling those assets at a discounted price. So let me take you back to 2008 for a moment, because I think that is the clearest example of what full liquidity collapse look like. Most people call it housing crisis. I was part of it. I suffered a lot. It took many years for me to recover. But if you think about it, what was housing crisis? It was a liquidity crisis. Here's what actually happened. People still wanted to buy homes. Sellers still wanted to sell homes. Demand was there, but banks stopped lending. Mortgage credit dried up almost overnight. No mortgage, no transaction. No transactions means no economy. Home prices fell by average 30% nationally. Some cities saw a drop of 50% or more. Nearly 9 million Americans lost their job between 2008 and 2010. And certainly I was one of them. All my friends were in the same boat. All my family members were struggling as well. And because of that situation, household wealth dropped by an estimated $13 trillion, just like that. Not because the fundamental of economy were broken, because the flow of money stopped. That's the power of liquidity and the danger of losing it. I'll give you my own example. I had owned a couple of stocks of companies that I thought are really great. They provide mission critical services. That means their business is very, very strong. Fundamentals were great. Finance were great. Growth looks great. Everything looked great. However, when the software sell-off began, people didn't care what was good or bad. They sold everything, which is another example of liquidity. All of a sudden, people lost trust in the system, kind of like what we saw in 2008. Banks lost trust in mortgages. So how we got here today? Now let's connect the history to today, because the path we are on has some uncomfortable similarities. Between 2020 and 2022, Federal Reserve kept interest rate near zero. The goal was to keep money flowing through the pandemic. It worked. We were happy about it, but it worked way too good. Banks loaded up on U.S. Treasury bonds, mortgage-backed securities at those low rates, safe at that time. Then inflation hit. In June 2022, the U.S. inflation rate peaked at 9.1%, the highest in over 40 years. The Fed responded with the most aggressive rate hike cycle in the modern history. Rate went from 0 to 5.25% in just over 18 months. Here's the problem nobody is talking about. Those old bonds banks bought at low rate are now worth significantly less. The value of a bond moves opposite to interest rates. Rate went up, bond values went down. US banks are currently sitting on estimated $500 billion in unrealized losses on their bond portfolios. They can't easily sell those bonds without locking in big losses. So that capital is now frozen. Liquidity problem, unavailable to lend. You guys remember Silicon Valley Bank situation, right? It was, I guess many of you guys are from California, so you probably remember. But the bank collapsed in March 2023 precisely because of this problem. It was forced to sell those bonds at a loss, and loss was too big to survive. Silicon Valley Bank was not the last domino, it was a warning. Real estate is where liquidity problems show up first and hit hardest. And right now, it's being squeezed from every direction at the same time. Inflation, even for existing property owners, insurance premiums, utility bills, property taxes, maintenance costs have all surged. Operating costs on multifamily properties are rising. Some estimates says between 20 to 30% increase. Then you have these higher interest rates. The average 30-year mortgage rate went from around 3% in 2021 to roughly over 7% just a couple of years ago. Monthly payments on, let's say, $400,000 home are probably double since the pandemic level. Millions of potential buyers are now locked out of the market. Then you have this floating rate debt time bombs as well. Huge number of commercial properties were purchased in 21 and 22 using cheap floating rates, meaning the interest rates are just over time. Those loans have now repriced to 7, 8, even 9%. Many owners simply cannot cover the payments. $1.5 trillion in commercial real estate debt is set to mature, hear this, by 2025. All right, so what are some of these big private firms are doing? For example, Blackstone, KKR, Apollo. They're sitting on hundreds of billions of dollars in dry powder. They're not panicking. They're watching for forced seller, distressed auctions, loan defaults. Every liquidity crisis in history has created generational buying opportunities for those who are patient and prepared. The question always is which side of that equation you end up on. You can either ride the elevator right now, or you can be patient and wait for the right moment. One of the most important things to understand about liquidity is this. It doesn't collapse overnight. It tightens slowly and it recovers slowly. The signs of tightening are subtle at first. Hiring slows, fewer homes sell, bank quietly raise their lending requirement, business delays investments. You notice these things creeping in individually. And then one day you look up and realize entire system is stuck. Right now, US bank lending growth has slowed to its lowest rates since 2008 crisis. Small business loan approval rates are near multi-year lows. The commercial real estate market has essentially frozen in many cities. Recovery follows the same gradual pattern, but the catalyst is always the same: lower interest rates. When the rate drops, mechanics works in reverse. Borrowing becomes cheaper, businesses expand, consumers buy homes, and lend more freely. And here's a number that should get your attention. It is estimated $30 to $40 trillion equity sitting inside American homes right now. When rates fall and homeowners feel confident enough to tap that equity through refinancing or selling, it releases a tsunami of liquidity into the system. That potential energy is sitting there right now idle, waiting for right conditions to release. And this is what President Trump wants to do. So where does this money actually come from? Quick but important detour. Because a lot of people don't realize this, all the money in financial system originates from Main Street. Your bank deposits, your 401k contribution, your pension fund, your retirement account. Wall Street takes that money and deploys it into loans, real estate, credit funds, private market funds, the fancy financial instruments you hear about, collateralized loan obligations, mortgage-backed securities, private credit funds, they are all ultimately funded by ordinary people's savings. This matters because it means when Wall Street have their liquidity problem, it is not some abstract event happening to rich people in tall buildings. It is a problem that travels directly back to the pension funds, the retirement accounts, and the savings of everyday people. The BlackRock fund freeze, those are real investors waiting for their money. Governments are not powerless here. They have several tools to increase liquidity. Let's walk through each one of those as well. Lower interest rates. So President Trump has been talking about that pretty much ever since he took the office, and he's been putting a lot of pressure on Powell. And now we're only a couple months away where we are going to have his guy on the chair of Federal Reserve. So we'll see how that goes. But lower interest rate is the most powerful lever available to the Feds. Simple. Lower rates equal to cheaper borrowing. Cheaper borrowing equals to more spending, and more spending means more money flowing. The Fed is expected to begin cutting rates, but inflation needs to reach their 2% target first. We are currently sitting around 3%, and then if this oil situation doesn't come in control, we might go back to 4 or 5%. And let me remind you, when we were sitting at 5% interest rate, we were still hiking. So keep that in mind. Tool number 2, increase the money supply. Stimulus checks, government transfers, direct payment to citizens. This works fast. We saw it during COVID time. People spend the money immediately and liquidity surges. The problem, we already saw what happened when you overdo it. In 2020, in 2021, stimulus packages injected roughly $5 trillion into the economy. It worked. People were happy, stock market all-time high, and then it caused the worst inflation crisis in the United States of America in the last 40 years. So if new Fed chair try to play around with some of these things, then we might be looking at another inflation problem. Now, another aspect of liquidity President Trump is thinking about is relaxation of bank regulations. That one is just as important. After 2008, banks were required to hold significantly more capital in reserve. The Basel III framework. The intent was to prevent another crisis. The side effect, it also limits lending. The U.S. Treasury is currently reviewing whether to loosen some of those capital requirements. More lending flexibility means more liquidity in the market, but also potentially more risk in the system. These banks can start investing in the ways government doesn't want them to do so. Because, if you have a lot of money and there's no regulations, what do? You take risk. Okay, this next one is awesome, but you're probably not going to like it. Government spending and job creation, infrastructure projects, public sector hiring, defense spending. When the government puts money into workers' pocket, those workers spend it, creating ripple of economic activity. It is slower than the rate cuts, but it is more durable. We do know that government is spending in a lot of different companies. Then those companies are doing very well, and government is certainly making money out of those projects. Government also wants to spend $1.5 trillion into defense, and a lot of that money, liquidity, will come back to the market as well. Another tool the government has is the student loan. So President Biden tried to play around with this as well. So this one doesn't get framed as a liquidity tool per se, but it sort of is, right? Americans hold over $1.7 trillion in student debt. It pays almost $500 to $1,000 a month on loan payments, and that means they have less money to spend anywhere else. So any policy that can reduce that burden directly increases the personal liquidity of millions of people all at the same time. So the balance government always have to strike is too little liquidity and the economy stalls, too much and you get inflation, asset bubbles, and kind of hangover we're still dealing with from 2020 and 2022. Now, so there is no free tool. Every tool has a cost. It's number one right now that people need to deal with is AI and unemployment. This is serious and it's moving fast. Companies squeezed by high cost and tighter margins, higher interest rate payments are accelerating AI adoption to cut headcounts. Goldman Sachs estimates AI could automate tasks currently performed by 300 million full-time workers globally. Some analysts believe US unemployment could hit double digits within 12 to 18 months as this plays out. If unemployment rises sharply, consumer spending will fall. Consumer spending is 70% of the US economy. You do the math. A spending collapse is a liquidity collapse. Question number two, tuition at a four-year university in the United States has risen over 180% since 1980. And some of these schools in California or Ivy League schools are charging gigantic tuition fees. The average student graduates with roughly $40,000 in debt. And that number is much higher for graduate degrees. Meanwhile, the salary premium for college degrees has been shrinking. This isn't just a social issue, it's a liquidity issue. A generation of young adults entering the workforce with debt load that consume a significant portion of their income, that is a generation that is less able to buy homes, start businesses, or even invest. That suppresses economic activity for decades. You might have already seen that kids are graduating from college and they're not able to get job. If they're not able to get job, how do you think they are going to spend in the US economy? So let me bring it all together so you better understand it. The entire economy runs on one thing, the flow of money. When money flows freely, businesses hire, people buy homes, investment grow, opportunities multiply, the pie gets bigger. We love this kind of environment. But when money stops flowing, lending slows, asset prices fall, businesses contract, and people start to shrink. What we are living through right now is a period of deliberate liquidity tightening. The Fed designed it that way to fight inflation. It is working. Inflation is coming down, except this detour that President Trump has taken. But the medicine has a side effect, and those side effects are starting to show up everywhere. Frozen funds, distressed real estate, cautious banks, a housing market stuck in place. And this is not a reason to panic. It is a reason to be aware. And I think President Trump is aware of it. That's why he has been putting a lot of pressure on Powell to reduce the interest rate. No. So this is what I'm going to leave you with. Liquidity doesn't guarantee success, but the lack of it almost always guarantee failure. Again and again during consultation calls, I see people who are chasing growth. They want to beat the market. They want to make the most money, but they don't realize when the music will stop, it is going to be very painful. So I hope this makes sense, especially if you are getting to your retirement age, or you might have already retired, or you know somebody who is not good with liquidity. Please share this video with them. Have them understand what I'm talking about. If you want to discuss the situation, you want to run through some math, then reach out to me. Just go to taxcodeadvisors.com and set up a consultation, and let's try to understand this together, because it is way too important to be ignored. Thank you so much, guys, and I'll see you next time.